World Exchange. This is Fumbled Wisdom.
Hey everyone, welcome to Fumbled Wisdom. Let me start with a simple observation. A lot of people try stock options at some point, and for many of them, it doesn't end well. They feel confused, they feel stressed, and often they lose money without fully understanding why it was created, for what reason. So, unless and until you understand that properly, you won't be able to do it successfully. Most people think options are about predicting the future, guessing whether a stock will go up or down, but that's not what they were originally designed for. To understand why people struggle with options, we first need to understand what options are actually meant to do. Here's the hard truth. Most people treat the options market like a casino. They bet on a direction, up or down, win or lose. But options are very different from buying a normal stock. When you buy a stock, there is no timer. If the price drops, you can wait months or even years for it to recover. Options don't give you that luxury. Options come with a clock. And when that clock runs out, if you are wrong, your money is gone. That's where most people get hurt. But here's the part almost nobody is taught. The options market was not created for gambling. It was created for insurance. You search any video online, you try to search for understanding stock options, nobody is going to teach you in a very detailed way why the options market was created. That's why I wanted to create this video to make you understand that how options were created as an insurance or risk management so that you don't lose money while just gambling or betting. Ask yourself this question. Why does the options market even exist? It wasn't created for people sitting at home trying to guess daily price movements. It was built for large investors, ETFs, money managers, funds, and institutions. These players already own a lot of stock. Imagine someone buys a stock early and makes a 50% or 60% of gain. They don't want to sell because then you come into tax implications. You don't want to pay IRS sometimes, right? But they also don't want to lose those gains if the market crashes. They ask a simple question. How do I protect what I already have gained or what I have already made? That's where the options come in. Not as a bet, but as a protection. You need to shift your mindset. Options are not lottery tickets. Options are insurance policies. Just like you insure your car, just like you insure your house. In insurance, you pay the premium for your house, you pay the premium monthly for your car, and when something really bad happens, you are free and the insurance takes over, right? Similarly, options were created for stock market. So let's take an example. Let's make this very real with an example. Imagine you own like 1,000 shares of Tesla at 450 per share. Now imagine this thought keeps bothering you. What if Tesla drops to $300? That would mean a 150,000 loss. Instead of panicking, instead of selling everything, you know what these ETFs and fund managers do? They buy insurance. You buy 10 put options at $450 strike price. Here's what that does. Most of you would know that one option means like 100 stocks. And here in this example, we are talking about like 1,000 stocks. So that's why we need to buy 10 put options, which will give a protection for our 1,000 shares. You buy 10 put options at the strike price of $450. Here's what that does. Even if Tesla crashes to $300 or even lower, you still have the right to sell your shares at $450. Your investment is protected. What did that protection cost? Maybe around $10,000. So instead of risking a $150,000 loss, you paid a much smaller amount for peace of mind. That's how the options were meant to be used. This is why the options market exists. And it is very similar for the upside movements too. This was the example for the put options. But if you understand how the call options work. So for example, today there is some huge news comes for Tesla that they have solved autonomy or they have solved robotaxi, right? And you know that the stock is going to go much higher from $450 to maybe $1,000 too. But you don't have the money right now, or your money is stuck in some other stock where you cannot buy the entire $1,000 shares of Tesla. what you do, you protect yourself from the upside movement. You now buy a call option at $450 strike price for maybe 3 months, which gives you the option to buy at $450, even though the strike price or the stock price for Tesla has reached $1,000. This is why the options market exists. If you think in this way, you will not lose money. So just make sure you're using stock options, not for gambling, not for guessing, but for protection. The big players don't use options the way most beginners do. They use options to manage risk. They use options to protect profits. They use options so that they can sleep at night. If this helped you understand options a little better, please like and subscribe my channel and this video so it encourages me to create more such videos. Thank you and see you in the next episode.